Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to run through Twitter, see what people are talking about, what news or information is being shared. It's going to be wealth building, financial related topics, or commodities. I think that the hot spot right now is in commodities, given where we are in the real estate cycle with inflation, with increasing interest rates, et cetera, et cetera. So that's why I focus on commodities. It very well could be good for crypto. I don't really know. We haven't gone through an expansionary phase of real estate with the crypto markets in existence. And tech stocks, they generally don't do as well as the net present value calculations done with growth in the future, discounted backwards with higher interest rates, generally push them down lower. So that's generally a tough spot to be during these market conditions. So I'll dive in here, give you my financial opinions of what people are talking about. And again, if you want to follow me on here, you can follow me at finding_finance. And if you want to head over to finding-value.com, you can sign up, get 50% off using the code Happy Birthday. Uh, we do have a platinum question and answer session Saturday at 7 a.m. Mountain Standard Time. If you guys have questions, we can talk about portfolios in terms of how I'm allocating my money, not your portfolio, but mine, and the individual stocks and the companies that I see that look good for opportunities and show you what I do to evaluate those. So Bob says, this is your weekly reminder that the U.S. labor market remains secularly tight. Initial claims falling to the lowest level in a few months, strongly countering the narrative that at this point in the cycle, once they start rising, they only move higher. So we are at very low levels in terms of initial claims and unemployment down here. So I don't know. I mean, it still looks very strong, in my opinion, when looking at a lot of these numbers. And a lot of people, they just cling on to that recession. They just keep saying recession quarter after quarter, month after month. And again, guys, I don't know when this recession is going to hit or if it's going to hit anytime soon. What I can say is a lot of the numbers look incredibly strong. Just because you start to see things start to weaken doesn't mean that they will remain weak. They very well could have dynamics in the market change and strengthen those things. But a lot of people believe that Powell's going to raise rates until something breaks. That's kind of what they say. Maybe he does. Maybe they continue to raise rates. Maybe something breaks. That doesn't necessarily fix the underlying problems in the market of underinvestment in commodities. So I don't see how that fixes anything. Yes, we can have a short term blip in a pullback, and it could be somewhat strong. But I'll just say this trying to time market pullbacks is incredibly difficult. No one has done it successfully for any length of time. And the pullbacks are temporary and they're usually not that big outside of real estate crashes, which I don't think we're going to have. So you're trying to time something that is a small pullback in a massive bull market, which I just think is incredibly tough to do. I just don't think it's possible. And from a symmetry standpoint, you've got 10 20x to the up or 10x to the upside of whatever you're in a lot of these things, and you're trying to miss like a 30 or 40% pullback, which may or may not come, and we don't know when exactly it is going to come. So you could easily rip 2 3 400% higher, get your pullback, which you normally get pullbacks that size, and then it rips up again. So it's tough to get right. It says in the quarter ending June 30th, D.R. Horton had net sales orders of 22,879 homes, up from 16,693 homes in the same quarter a year ago. Net sales up, revenues up, profits down. Why? Incentives and adjusted base pricing is what we've got here for profits. But overall, the volume, what we look for is not necessarily the profits of D.R. Horton. We're looking at the volume of homes. So net sale orders 22,879 versus 16,693. If we sell more new homes, that means more new loans, and more new loans into the system is credit expansion, which is inflationary from that perspective. Uselink talking about URNM. We've got a long-term status. It's quite simple. Yeah, it is. It's very simple. You've got a nice big pattern here that is consolidating, and it's about to break out. When we break out, hopefully we get a big run. That's what we're all waiting for. This is what we're waiting for. And this is the first leg up. This is your big consolidation. Hopefully we can break here and move on higher again. Patrick Karam, it says in 1980, silver peaked 5.8x higher than its 3-year moving average. Today's 3-year moving average is $23.50. 23.50 times 5.8 equals $136. So that's what he's got there. We've got a nice early breakout line that we're trying to break out of. We've got the 3-year moving average. That's right basically where it's at $23.50. So it's the second biggest takeoff platform in over 50 years. Not sure many understand what is coming up for silver. I hope that's the case. I'm ready for this big move here in silver. It says it's been quite the hibernation, but platinum inventories finally saw a nice drawdown to the tune of 10%. So we've got a nice drawdown in platinum inventories. Platinum is the cheapest metal in terms of a ratio perspective. It's the cheapest against all the other metals. It is a very cheap asset in this world. There's like 4 or 5 different cheap assets right now. Dry bulk or the Baltic Dry Index is incredibly cheap. Platinum's incredibly cheap. Natural gas is incredibly cheap. And I would say uranium's cheap and oil's cheap too, but those first 3 are all off the page stupid cheap. Peter says oil doing what it should, consolidating after big move higher and awaiting additional physical tightness. Crude draws in U.S. will be bigger as Gulf Coast temps drop and refiners run without hiccups. Next 10 to 12 weeks, we'll see inventory drain and prices rise. Second half setup remains extraordinary. Let's hope that's the case, guys. We've got when crash. We've got Enron and Tesla. So Enron's the blue, Tesla's the red, and then we've got when crash. I think the market conditions are ripe for some of these tech companies to get a pretty stiff headwind. Increasing interest rates from increasing inflation is what's going to cause that headwind. COMEX silver inventory plunged 1.96 million ounces today. The true silver squeeze is upon us, and paper traders are asleep at the wheel. Well, let's hope that inventory continues to draw down. I don't put too much of my. I mean, yeah, the inventories are drawn down. I know we're running deficits. I kind of just leave that in the background. As long as silver, platinum, and all these different metals are cheap on a ratio perspective, I will continue to accumulate. And when that goes up at some point, hopefully I'm well positioned for the big breakout moves. But it looks like inventories continue to plunge. That's what we're seeing. Here's Grady. Grady's got a lot of really good charts. I really do like his charting. He looks at a lot of information on a wide range of things. He says the 2-year backtest for this inflation index looks just about done. A volatile backtest gathering energy. As said for months, the second inflationary wave is soon here. Getting prepared should be a priority. So I think he takes this stuff a little bit more serious, which I tend to agree with. We could see a massive move in inflation, guys. And I don't know what that looks like. I don't know if anyone who's really alive has really experienced what could potentially come. But right now, this is the Pring Inflation Index. And what we did is we broke out, we did a retest, back test, and now we're ready to basically coil up and get moving. A lot of the metals are doing that. We've got gold doing it, silver doing it, platinum's doing it. Oil broke out just like this and is doing a retest. A lot of fertilizer companies are doing it. Coal's doing it. Aluminum's kind of setting this all up. Guys, this is going to get ridiculous. I don't know. I don't even know if what the driving factor is behind all of this. I mean, I know the housing market, but this seems like it's bigger than just the housing market, which I think it is the case. I think it's something to do with the dollar and the dollar about to get dominated, perhaps. I don't know. So watch that DXY, watch all this information because we could see some serious moves in a lot of these um, commodities. And I kind of feel like you're either on the train or you're not. What do I mean by that? Like, if you're not in it, you could get seriously hurt. I'm almost to that point where it's like, man, you're either in it or you're not. I mean, and we'll see when we get this big move coming up. It says the U.S. Treasury admits that the debt situation is unsustainable, even publishing it in a graph. Problem is, their graph, black line, is optimistic. The reality is that the problem likely will soon go parabolic, which is the red line, and it's just math, says James. And this is what I mean by the potential problem and why commodity charts all look like they're just ready to launch to the moon. This could be one of the drivers of it, and this is the historical and current policy projections for debt held by the public. And everything is just going vertical here, guys. Like, this is ridiculous, and this is not that far away where it really starts going vertical. It's 2040. 2040, 2050 is where it goes massively vertical. But I mean, we are going vertical and everything is moving at exponential speeds. I, I think with a constraint on the commodity side, it's going to happen even earlier. So, man, I don't know. This is getting kind of serious. Grady says the ratio GDX versus gold already has the often required false breakout in order to gather energy, so that volatility increasing move is already done. Next major move up is probably one for the history books. It is the bigger the base, the higher in space. The chart looks ready. And we've got gold with the breakout and the back test. We've got GDX versus GLD, which is we've got a breakout, a false breakdown, and now we're ready to move on up. What he's looking for is he's looking for the break above the black line where the real fireworks start, which is a resistance level that we're trying to break through. I'm in all this stuff. I'm ready to go, guys. I'm locked and loaded. Loaded to the what is it? What did he say in the Big Short? Loaded to the tits or something. Whatever he said. Here's GDX, large gold miners. They're starting to move on up as well. They've got the breakout back test in a very large 12-year bullish triangle. Guys, these bigger triangles like this equal very big moves, and we're getting closer. Maybe we're 6 months out. Maybe we're not. I don't know. We'll see. I mean, I think we could be very close to a big move. Could be weeks. It says my guess is for January 24 from the data right now. Home prices up 3 to 5% year over year. Inventory down 20%. Transaction volume up 10% is his guesses for January 24 from the data right now. Assuming rates stay between 7 and 6%, no shock like bank failures and recession still in the future. So that's his guess. Grady again says when markets do a major trend reversal, it's vital to change your mindset. Have to believe in the resumed bull or end up being a victim of wall of worry. And for that, you need to have the right mindset, the tools and experience. Plus, you must ignore bias, emotions, narratives, and talking heads. And he's got, the beautiful chart of gold that's broken out of the falling wedge here. It's breaking on higher. It looks absolutely great. North Star says if the charts breakdown is shown, gold and silver will be highly likely to enter a new bull market phase. Any guesses what this chart is? Um, I don't know. If I were to take a guess, I would say it's probably the gold to silver ratio or something like that, or something where gold and silver's priced against, um, like the Dow Jones or something like that. That's my guess. Dow Jones to gold ratio, and it's going to be favorable for gold. So Dow Jones to gold ratio is probably my guess. There you go. Grady says, as for said for months, the second inflationary wave is soon here. This chart shows lumber backtesting support a third time as expected, this time with increasing volatility. The pushed narrative is inflation is done. No, it's not by a mile. So we've got an increasing lows here, and we came and did a backtest. So we kind of came up, backtest, and it looks like we're ready to go again. He says volume thin zone equals little volume resistance going back up. And we're basically coming back to the support level. Time to hit it. And we've got turning there for MACD, and the stochastics are bottoming. Got Tavi here. He says the U.S. government continues to operate as if we are facing another pandemic lockdown from a fiscal spending and debt growth perspective. See below the issuance of long maturity debt instruments continuing to rise at unsustainable levels. Never mind that nearly half of the federal debt must be refinanced at substantially higher rates in the next 2 years. In the end, the monetary authorities will bear the responsibility for this situation. The Fed must either induce a deflationary shock to stimulate demand for treasuries or assume the role of being the buyer of last resort of these instruments. This is the US long maturity debt issuances, and you can see just how massive it's been in 2020 onward. So again, what does he mean by this? The Fed, in order to release this amount of debt, you have to do two things. They either have to buy it themselves and do quantitative easing, because the demand for this much debt is not there, and you're going to continue to increase interest rates. Or you create a crisis, which is a deflationary shock to the system to stimulate demand, to drive money flows back into US Treasury debt issuances. So back into bonds. So they either take that supply and buy it themselves, or you create the demand for the bonds through destroying the markets. I don't know what they're going to do. We'll see. There's another one from Grady. He says, as expected, this ratio chart is now turning, and it's your ticket to financial independence. The silver proxy AG is extremely undervalued versus tech proxy darling Nvidia. The major trend is reversing. Do take note. Fortunes will be made. Historical. Do not miss. And this is AG in relationship to Nvidia. It has a false breakout in this falling wedge, and it's about to rip to the upside. What's going to happen is AG is going to go up and Nvidia is going to go down all at the same time. Is most likely what's going to happen. And maybe it gets back to those all-time highs. I don't know. We'll have to see. We've got Jim Bianco. He says the percentage of homes selling above their list price peaked in March of 2022 when over half went above the list price. After bottoming in January, this metric is moving up. Now 1/3 of the homes are selling above list. This is still higher than anything seen pre-pandemic for those. Peter says every single U.S. recession has begun when the corporate sector financial balance and economy-wide measure of free cash flow was in deficit. Today, it is in surplus of 2% of gross value added. So this isn't jiving with past recessions. Recessions are all down here, and we're all the way up here in terms of U.S. corporate sector financial balance. And that's where we're going to end it there, guys. So that's what we've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't. We're here. We talked a lot about debt and how parabolic it could potentially go in the future. We've got insanely good setups in precious metals. It all seems like it fits together in one big puzzle. High debt, uncontrollable debt, and we've got charts across the board that look fantastic for precious metals and commodities. All right, guys, that's all I've got for today. I will catch you next time. This is Finding Value.